Hello, this is Greg Britton, your Spokane mortgage strategist. It is Monday, April 18th. Time for Greg's home update. Hope you like the glasses. They hopefully they make me look smarter because I need all the help I can get. So today, let's see. Well, let's look back last week at what happened in the mortgage bond and rate market and housing market in general. As far as rates and bonds go, as you know, the mortgage bond, the appetite, the price people pay, investors for mortgage bonds determines the rates. We talk about that every week. So what happened last week? Well, there was a bunch of good Treasury, U.S. Treasury auctions, and those affect mortgage bond buyers as well. It just shows, especially the longer term Treasuries like 10-year and 30-year, if there's a strong appetite for those, there's typically a strong appetite for mortgage bonds as well because they're pretty similar in how they work. So there was some strong Treasury auctions that helped mortgage bonds out and helped rates overall. From Monday to Friday last week, we saw some decent gains in mortgage bonds, which helped rates stay low. In fact, they ticked the 30-year Fannie Mae rate ticked back below 5% because it had been right at 5 and an eighth, but it went back down into the 4 and 7/8, 4 and 3/4 range. But and a lot of those gains were on Friday, by the way, as the consumer price index came out worse than expected. So bond buyers were expecting to see more inflationary concerns in the CPI, and actually came in low, which means there's really those concerns aren't there, which bought the bond buyers back, again increasing the value of the bond, decreasing the rate. So what's on the agenda this week? Well, if you look, I'm going to click over here for a second. If you look at the newsletter, on the newsletter you have the chart in the middle, and if you look on the chart, you'll see this blue line on the top going down, down, down. That's the 100-day moving average of that 4.5% Fannie Mae coupon. And every time we've touched that, we've only touched it twice this year. Every time we come up against that, what I call level of resistance, we've bounced off, and the bond has dropped lower and rates higher. It's a very strong resistance level, and the bond hasn't been able to break through it. So actually, as of ending today, we're slightly above it, which means to stay there or to go any further up, again, bonds up, rates down, to go any further up in bond pricing and help rates, boy, we're going to need something pretty catastrophic because that level of resistance is so strong. So we'll see how that goes, and I'll be getting back to you next week on that. Other than that, you'll see the foreclosures filings are down, and I'm not quite sure how much I believe that report. I mean, I'm sure they are, but I'm not quite sure if that's due to the pressure from the Fed um, on the way banks are doing foreclosures and trying to get them to back off a little, and all the concern about are they being done right. So that might be part of it. If it's true that the filings are way down, that's great. We need to work through that foreclosure inventory to get back to a more stable housing market. So we'll see how that plays out as well. Have a fantastic week, and I will see you next Monday.